Have you ever wondered what caused the 2007 financial crisis? An event of such gravity that it sent shockwaves across the globe, shaking financial markets and impacting millions of lives. This crisis was not just a hiccup in the economic world, but a massive earthquake that altered the financial landscape forever. Today we take a deep dive into the causes and the unfolding of the 2007 financial crisis, exploring the intricate web of events that led to one of the most devastating economic downturns in modern history. It all started with the bursting of the US housing bubble. So, what exactly is a housing bubble? Think of it as a period of rapid growth in property prices, fueled by increased demand, speculation, and exuberant behavior. It's like a party where everyone is having a great time until the music stops and suddenly there's a scramble for the exits. In the early 2000s, the US was in the midst of such a party. Housing prices were skyrocketing and people were buying homes they couldn't afford, thinking the good times would never end. Banks were more than happy to lend, often with little regard for the borrower's ability to repay. But like all parties, this one had to end. And when it did, it was catastrophic. Housing prices plummeted, leaving many with homes worth less than their mortgages. Banks were left with bad debts and a severe credit crunch ensued. This was just the beginning of a financial disaster that had grim global implications. The collapse of the housing bubble gave way to the subprime mortgage crisis. Subprime mortgages, you see, are loans given to borrowers who are considered high risk due to their low credit scores or other financial shortcomings. In the golden days of the housing bubble, these subprime mortgages were handed out like candy at a parade. Financial institutions, fueled by greed and short-term gains, began to loosen their lending standards. They packaged these risky loans into complex financial products known as mortgage-backed securities, or MBS. Investors, lured by the promise of high returns, bought these MBS without fully understanding the risk involved. Everything was rosy until it wasn't. When the housing bubble burst, it set off a chain reaction. Home prices plummeted, leaving many homeowners owing more on their mortgage than their homes were worth. This led to a surge in defaults and foreclosures. Those risky subprime mortgages, they turned toxic. The MBS that were once golden began to crumble, causing colossal losses for the investors. Banks and financial institutions who had heavily invested in these securities found themselves on the brink of collapse. The financial system was in a state of shock. Trust evaporated overnight and lending between banks virtually stopped. The economy was on the edge of the abyss. The subprime mortgage crisis was a ticking time bomb that eventually exploded, leading to the 2007 financial crisis. This crisis serves as a harsh reminder of the dangers of reckless lending and the importance of financial regulation. The financial crisis was not limited to the United States. It had a far-reaching global impact. Indeed, the ripples of the 2007 financial crisis spread far and wide, touching every corner of the globe. It was a tidal wave that swept over financial markets, leaving hardly any untouched. From London to Tokyo, from Sydney to Johannesburg, stock markets plummeted, eroding trillions of dollars in wealth. The crisis sent shockwaves through the global banking sector, leading to the collapse of some of the world's most prominent banks. It was an era of uncertainty, where no investment seemed safe. But the crisis had a human face as well. Imagine being a breadwinner, one day secure in a job, and the next, unemployed. People across the globe found themselves in this exact predicament. The crisis triggered massive layoffs as companies struggled to stay afloat amidst the economic downturn. The unemployment rate skyrocketed, and many people's livelihoods were upended. Moreover, the crisis led to a significant increase in the number of people living in poverty. The World Bank estimated that tens of millions of people fell into extreme poverty as a result of the crisis. The aftermath of the crisis was also marked by social unrest and political instability in many countries. It exposed the underlying weaknesses in the global economic system and underscored the need for profound reforms. The crisis took a heavy toll on economies around the world, leading to a global recession. It was a sobering reminder of how interconnected the world is and how a crisis in one part of the globe can ripple out to affect us all. Governments and central banks worldwide were put to the test as they tried to restore stability to financial markets. When the financial crisis hit, it wasn't just individuals and businesses that felt the pinch. Governments and central banks found themselves in uncharted territory, facing a global financial meltdown of a magnitude not seen since the Great Depression. Their response was swift and decisive, aimed at restoring stability and confidence in the markets. Central banks, like the Federal Reserve in the United States, slashed interest rates to near zero. This made borrowing cheaper, encouraging businesses and individuals to take out loans and stimulate the economy. Simultaneously, governments rolled out unprecedented fiscal stimulus packages. They pumped trillions of dollars into the economy, hoping to jumpstart growth and prevent a deep recession. But these weren't the only measures taken. Central banks also used a tool called quantitative easing, essentially creating new money to buy government bonds and other financial assets. This increased the money supply, pushing down interest rates even further and encouraging spending and investment. Governments also had to step in to save failing banks, deeming them too big to fail. This meant injecting capital into these banks to prevent their collapse, a move that was controversial but seen as necessary to prevent a domino effect that could have brought down the entire financial system. It was a time of swift action and bold decisions, a demonstration of the significant role governments and central banks play in maintaining financial stability. Through these measures, governments and central banks were able to slowly but surely bring financial markets back to shape. The 2007 financial crisis was a stark reminder of the interconnectedness of global economies. In a nutshell, we've journeyed through the tumultuous era of the 2007 financial crisis, which was marked by a housing bubble and a subsequent subprime mortgage crisis. We've seen how these events spiraled into a global impact, affecting livelihoods around the world and shaking financial markets to their core. This crisis underscored the pivotal role governments and central banks play in steering economies back on course. Their response, though met with criticism, was instrumental in restoring some semblance of stability. We've also learned that financial literacy is not just for the bankers or the brokers, it's for everyone. Understanding the basics of finance, from mortgages to market trends, can empower us to make informed decisions and safeguard our financial future. So let's remember the lessons from 2007 and strive to be proactive, not reactive, when it comes to our finances. Thank you for watching. If you found this video informative, please like, share, and subscribe to our channel for more content like this.